when the markets just start to look a bit shaky, when investors are just a bit nervous, wherein we need words of experience. And no better man than Shailesh Bhan with me. 20 years of experience, needs no introduction. Managing funds, managing markets. Shailesh, thanks so much for joining in. You're looking unusually calm. You don't think that this fall is a start of something more serious? Because a lot of people are equating the key events that are lined up all of the next 2 weeks, be it the Fed, be it the Brexit, or be it the Chinese inclusion, whether or not this, that, etc., will lead to a bit of a correction.
See, normal corrections are possible, but I think every correction, given that the underlying cyclical economic recovery is underway in India, is actually creating opportunity to invest for at least a 2-3 year kind of a window. So I think these are opportunities which have come, like in January and February, people talked about China as the reason for a collapse or a correction. Right now it's a very different kind of set of reasons coming from international markets. But I think investors have 3-year money. I think these are very good, interesting times to participate in Indian equities.
So let's try and understand this, Shailesh. Assuming that there is a bit of a fall due to whatever the reason may be, I mean, a Brexit vote could bring about a temporary downtick in the markets, or something else, or maybe China collapses a little bit, as the case may be, whatever, over the course of the next 6 months. Do you believe that these global instances, which also bring about a fall into the Indian markets as well, because we are correlated, will be used by you and should be used by investors as buying opportunities?
It's very clear. See, we are coming out of 5-6 very difficult years of economic growth. And as you accelerate, it takes a bit of time for that acceleration to set in. But now we are finding many indicators guiding towards an improvement year over year in terms of economic growth. So we are seeing now that moving to even core sectors, like core sectors, cement volumes have started to pick up last 3-4 months. Steel volumes are picking up. So core sector activities also started to improve. So I think over a period of time, the next 12 months, this acceleration will start getting visible in at least maybe 8-10 of the 12 important areas of the economy, and that's a good enough opportunity to capitalize on.
You would shrug off what comes out in these reported IIP numbers or some of the other numbers as well, because I hear a lot of people now starting to say that, hey, there is a GDP data, yes, there is an IIP data, but now we are developing our own set of high frequency indicators because they think that that's a better way to approach investing than following these numbers.
See, this data also reflects that the current level of economic activity is still muted. So it's not like, every single area has started to fire. But now you are finding that, earlier 3 variables used to fire, now 6 out of 12, 7 out of 12 are firing. And as you accelerate, it feeds into one sector, feeds into the other in terms of growth. So I think if you have a right direction, I think directionally we are very well set. You look at interest rates being transmitted well over the next 1 year as well, that will also benefit. So the level of economic activity today is so low that, where it starts off, you could actually end up having meaningful double-digit economic activity in terms of numbers over a 12-18 month window. The base levels are very low for 3, 4 years, so that's a big support. In fact, this quarter's earnings, which you saw, actually surprised. If you remove financials from the reported numbers, you would find very comfortable double-digit earnings growth ahead of what people talked about.
Yep. In fact, I think I heard some statistics, the best quarter in the last 6 or last 8 or last 12, as the case may be. So yeah, there you're right on. Now, Shailesh manages, of course, some of the key portfolios out at Reliance AMC. Amongst the many that he probably oversees, the Reliance Equity Opportunities Fund as well. I have some data points out here for the benefit of our viewers. Since inception until March 31st, 2016, the scheme has returned 18.75% versus the benchmark of 13%. And I hope my numbers are right. That's a staggering outperformance compared to the benchmark as well. So, Shailesh, now my question to you is this. You sound bullish on the market from a long-term perspective. Any corrections that come in are probably opportunities to buy. And I think if I take a leaf from your answer, you did mention somewhere that the core sector performances are now starting to kick in. How does an average investor, or how do you right now look to position your portfolio? Would you be skewed towards economic revival candidates because that will give the high beta, because they quite frankly haven't really performed? I mean, private banks have done that, but PSU banks, cap goods, etc. haven't really given the performance over the course of the last couple of years.
See, growth initially, given that global growth is weak, global trade itself is weak, I think the driving force for the next near term, at least, or the next 12-18 months, seems to be domestic economic recovery. It could be into many components. One, it could just be normal urban consumption driven activity with lower interest rates, better sentiment, lower inflation, better pay commission flows and stuff like that. That can be one variable which we are very confident will be an important variable. The second area will be normal economic change. For example, you're seeing commercial vehicle volumes ticking in for now. It's about 8 quarters of double-digit plus growth year over year of delivering. So you're finding many such variables turning. Cement volumes after flat last year have started to turn now. Steel volumes have started to turn. Petrol, diesel consumption volumes are double-digit, for at least on an average for the last 4-5 months. So a lot of variables on the core sector are also now starting to show an improvement, though on a low base.
Right.
So as recovery accelerates, you'll find that over a 12-18 month window, if the trend continues like this, there definitely is a good opportunity to make money in economic revival in India.
Everybody says that for this to happen now, monsoon needs to deliver. It's almost, in a manner of speaking, a company which needs to deliver on earnings. Monsoon needs to deliver for our markets to do well. My question is, it's probably already priced in. What if, right now, while we believe it will be in a normal or an above par monsoon, what if it isn't?
See, if you have a normal monsoon or an average monsoon plus or minus 3, 4, 5% of what is expected, that's fine enough. If you have a distribution of monsoon which is completely improper, then there is a challenge.
Right.
So at this point of time, every single indicator talks about a rational distribution and a reasonable set, but we'll get to know over a 2-3 month window only. It won't be possible to really get a sense even today.
Right.
Monsoons will matter because they will impact inflation, food inflation very specifically, will impact availability of water itself for a lot of industrial activity and stuff like that, in addition to the real crisis of availability of water for drinking.
Yeah.
So it does matter, but I think to conclude that, it's not the only variable which will matter. So it's an important variable. A normal, a plus or minus 5% is an acceptable level, but it should not be a drought in areas which has already been suffering significantly.
My question is, before I get to some key components within your funds as well, my question is, if it's a subpar monsoon compared to what we're expecting as well, or even otherwise, could it derail the markets completely, or do you believe instead of a really strong rampant move, we'll probably have a sluggish move, but northwards it will be?
Sure. My belief it will be a northward move, if you get into it, despite if you have a little bit of subpar monsoon, unless it's a complete disaster, that's a different thing.
Of course.
But I think rationally speaking, I think there are many levers which are working, which are, independent of just the rainfall side of it.
Got it.
And the base of even rural growth is pretty low for last 2 years. So what's working is something else in the economy today.
Okay. Now, 2 or 3 of your answers out of the ones that we've had right now have an indication towards the core economy, towards interest rates, and which brings me to banking, because I think even if I look at your key fund, which is either the top 200 or the Reliance Equity Opportunities Fund, there is a large bias towards banking. Now, obviously, the index has 27-28%. You would probably need to have that as well. But what is the most critical element right now for banks to do well? I know the first answer will be there are a lot of things that are happening, so a lot of things need to work. But just looking at the banking space right now, what do you think are the 1 or 2 key things which need to happen for the sector to continue doing well?
See, within banking, there are 2 primary sub-segments, the corporate lenders and the retail lenders. Retail lenders are firing. They're growing at 16-17%. Even last year was very good for them. And even outlook for retail lending is pretty robust for the the near term. The key thing to fire is corporate credit growth, or improvement in quality of assets, or at least getting behind the complete NPA problem.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.